And on today's show, how leveraging collateral can optimize your assets. Part 5 of this week's series on premium financing using Index Universal Life with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Insmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Robert. Day 5. Wow.
Thanks, Steve.
If you have coming into our show today, I highly recommend that you go out and watch this whole series this week in succession, in sequence. I really think it'll help your tutorial learning experience. And even if you're saying, Steve, I'm not really into premium financing, there is so much intel embedded in this series on IUL. I think you're going to find yourself having a revelation on basic mechanics, mortality mechanics, and how these products work. And they work really well. I really love this. Now, we're talking about collateral, premium financing.
Right.
I'm assuming we talked about this a little bit in the generic Monday. I know I have to have collateral. I'm going to collateralize the policy.
Correct.
So there's going to be cash values. That's the bank. But those surrender years may not give me really cash flow enough to do this. So what is the typical bank or our lending institution? What are they looking for beyond the policy cash values?
Well, cash is king. Mm-hmm. So anytime it's possible, they're obviously going to prefer to use CDs, money markets, liquid assets, if it's at all possible.
Okay, so the lender's always 100% secure. He's going to use the cash value and external collateral. That external collateral will first be maybe his money markets, maybe his CD certificates of deposit, maybe even an annuity that's a fixed plate. When you do this, are they trying to give you 100%, or are they trying to go above the line of their collateralization to maybe include the interest payment, or to be a little above the line total loan?
No, they're always going to be 100% secure at all times. So they're going to be doing evaluation each and every year. They're not really trying to over-collateralize. The policy is going to be the primary form of collateral. And then they're going to be doing evaluation both of the policy each and every year and of the external collateral. And there may be an additional amount of collateral that has to be posted up.
Okay, let me make sure I got this. So really, the bank's going to look at an annual statement. An in-force ledger is going to be presented.
Correct.
They're going to make those numbers. They're going to make their established collateral based on these real numbers. After the first year, after the second year, every year they're going to look at this.
Yeah, and at the beginning, they're going to make worst-case assumptions. So they don't know how the policy is going to perform day one. So they're going to assume the worst. They're going to assume the guaranteed crediting rate. And then after the policy is performed for a year, then they can look at actual crediting rates and reevaluate their assumptions.
Now, when we're looking to see how we pre-qualify a client for this, what are we looking? Do you have any thresholds, like here's net worth or here's liquidity? What am I looking for when I'm looking at premium financing using Index Universal Life?
Well, different carriers have different guidelines, but typically they're looking for clients that have a net worth of at least $5 million, a household income of at least $300,000, and some good liquidity. And so there are liquidity formulas that they have for that as well. They also have to have good credit worthiness as well. And so there are a number of different formulas and standards that they apply, but those are the basic.
Okay, so if our advisors who are watching the show all this week are very interested in doing this, they're thinking in their mind, okay, my threshold of net worth is $5 million.
Correct.
I need to have a W-2 or 1099 net of taxes, maybe around $300K annual income. I got to have good credit, and a lot of those assets are going to have to be liquidity. So if I have a real estate guy that's tied up in all of this, that may be a problem.
It often is a problem.
It is. So it's a liquidity issue.
It's often a liquidity issue, and it has to be suitable on top of all of that. They have to understand the risks and appreciate them and be able to obviously have a way to pay the interest each and every year, because we don't roll the interest up. So this is not free insurance. It's not sold as free insurance.
So generally, our clients in these scenarios are paying their interest, generally, and they have to understand there could be some downside. They might have I wouldn't want to call it a margin call, but they might have a call. They might have to pay a little bit more than they expected because certain things may not work out. But we're looking at probability issues. And do we show the bank that, some of the probability, some of the historicity to this, like we did yesterday? Do you show that to the bank?
Well, yes, absolutely. So the bank understands our design. They understand the range of ways that this can go. And so does the carrier. So it's very important that all the parties involved, the client, the bank, and the lender.
I'm sorry, I just have a great question here.
Sure.
What's the learning curve of a banking institution when they're just being introduced to Index Universal Life? I mean, life insurance is one issue. Oh, I got indices on top of that.
Sure.
Oh, I have arbitrage of policy loans. I mean, there's a lot of, this must be new territory for the banks.
Understand that the bank is out of the equation before there's any arbitrage.
But don't they have to understand what's going on here?
Well, not really, because when the bank is paid off, that's the day that arbitrage begins.
So, but when you have to, when I'm thinking about if I'm in front of the bank for the first time, do you have specific lenders that you're talking about then that are already accustomed to this?
Yes, I mean, we basically use one lender, and that makes the learning curve a lot easier. We use a publicly traded lender. It's part of reducing risk, and I think one of the least appreciated of all the risks is lender risk. Least talked about. This is not something you want to rate shop. You don't want to go from lender to lender to lender to shave off a tenth of a basis point off of your LIBOR-based rate. You want to make sure that you're dealing with a reputable lender, ideally a publicly traded lender that is transparent, that has good financials, that is subject to Federal Reserve audits. You want to make sure that you're not subject to calls, that the loan is not a demand note. So, and ideally, our lender doesn't charge fees or have prepayment penalties. So these are all things that are very, very important to us. There may be interest rates out there that are, again, slightly less, but lender risk is very, very important to us.
When we come back from the break, I want to ask a few questions of Robert in regards to what kind of data collection do I need to do on this, because it sounds like I need a little bit more than my traditional. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with Robert Strauss, our funding strategist and attorney, and we're talking about, before we get into the more on the collateralization, Robert, I'm thinking, okay, I'm watching this show. I'm ready. I got a few clients in my mind. The fear of many advisors when we talk this way is, how big is that data collector going to be?
Yeah.
Is it just intense? Is it like a phone book? Or is it pretty basic? What do I need to play in this arena?
Well, it can be pretty scary, but we have a department that makes it a lot easier for you, first of all. So our finance department works with the agents and assists with data collection, number one.
Let me stop you there. Are they pre-qualifying then right up front? We're not doing illustrations. We're not sending them to a paramed. We're pre-qualifying from the get-go.
Right up front, our finance person is going to be talking to the agent, asking for financial information, and very possibly rejecting the case before it gets anywhere.
So there's a lot of pre-qualifying going on.
Correct.
Okay, I'm going to need to have a net worth statement, right?
Absolutely.
I got to have that.
Absolutely.
And I'm imagining, well, how many years back on my 1040 tax returns? 2 years, 3 years?
At least 2 years, possibly 3. Correct.
Okay, so, and then when I list my assets, I noticed that you said in the first segment, there's an issue of liquidity here. So we have to have some freed assets.
And sometimes business statements too. If a certain percentage of the assets are, are business assets, 60% or more, then now we're going to need business statements as well. So it really depends which direction the financial statements take us, because that could lead to a whole new category of statements as well.
Let's say I did this exactly right. I was the advisor. I interfaced with your loan officer and lenders, the people in your organization that actually are the liaison between you and the lender.
Correct.
And let's say I got all the information correctly. I actually collect. I know it's probably not going to happen on the first pass, but let's just say I got it done.
Yep.
And now, what's from the time that I've collected all the information I've asked to the time of the decision, can I move forward? What is the general downtime? What do you think that is?
90 days if everybody does what they're supposed to do and cooperates.
So can I make a pre-judgment call saying the finances, everything looks great, I think we're going to have a good time with the bank, I can start underwriting. So I can almost, once I get past the basic cursory review, I know, hey, the client is gonna probably qualify here. Let's begin the underwriting process. So by the time the bank's done, the underwriting's done, and we're ready to issue the policy.
Now we still won't submit any of that to the lender until the underwriting is quite far along. So we'll take a good look at it. We'll gather the information, and we'll pre-underwrite the loan portion of it, but we still won't submit that to the lender until we know that the medical underwriting is either approved or about to be approved. At that point, it all kind of comes together, and then we'll package it and submit it to the lender, because the loan underwriting still is so intensive that we don't want to go through that process until we're pretty sure.
Now, we haven't been really mentioning carrier names, and I want to keep it that way, but that being said, we're using some of the top-of-the-line index universal life carriers, which may not be the best underwriting carriers. So do you have punt positions when the client isn't going to be perfect for the one carrier that you'd really like to do because they have really good features? Do you have punt positions to go to second or third carriers?
We do.
Because of underwriting?
We do. So we have several carriers, and actually, you know, they've all been very. I haven't had any complaints at all. They've all been very responsive, and obviously they, you know, they have their areas of expertise and their areas of specialty, I should say. But so sometimes we know which carrier to submit to from the very beginning.
Just because of the medical issues.
Because of the medical issues, sure.
Well, let's just review this before we close out the show. Here's some of the sources of collateral. We talked about certificates of deposit. I'm wondering, do they care where that is, or do they want the CD to be moved to the bank?
No.
But do you get any preferred rate because of that?
We don't get a preferred rate, but it does go quicker. So if the client has no preference, it is an easier thing to do. However, it's not something that anyone pushes. So if they want to take out their own CD at their own bank, as long as the lender has a relationship with whoever the financial institution is where they want to keep their assets, that's fine.
And brokerage accounts now, tell me about, you talk about having a working relationship just now. There's working relationship issues here using a brokerage account.
Correct. There has to be some kind of working relationship because they have to agree on some kind of an assignment agreement.
And when we're talking about the life cash values, we talked about already that the policy is going to be collateralized from the day one of issue. But I noticed that as the numbers grow up, there could be less collateral. The loan could start to pay, because you're paying a little bit of principal on a lot of these scenarios. So the collateralization starts to also be reduced as well. Is that correct? So and then what about the letters of credit? How big is that in your scenario?
It's not very big. We don't see too many letters of credit. I mean, that would be used for, unusual sources of collateral, real estate, art, things that perhaps people, in perhaps very large cases, where people want to post up, assets where they have existing banking relationships, and those assets are not suitable for our lender, but their existing bank is willing to issue a letter of credit instead. The letter of credit could be used, but not the asset itself.
I see. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant, and we'll see you next week.